If I had to look at this market today from scratch, knowing what I know about AI hardware, data center power, nuclear energy, uranium supply, and defense technology, I would not look at it like a normal stock picker. Most people think investing right now is about guessing whether the S&P goes up next week, or whether some chip stock is too expensive, or whether the Fed says one magical word in a press conference. But that's not what this is about anymore. We're watching capital move into the physical backbone of the next economy, the computers, the electricity, the fuel, the grid, the sensors, the factories, the boring stuff that suddenly isn't boring. Today is Monday, April 27th in New York. And before we go deeper, comment the day and date you're watching from, because if you watch this 2 weeks from now, the headlines may change, but the structure underneath probably will not. And if you value this type of work, support the channel by subscribing and commenting John A.G. Best, short and simple. It tells me you're here for real research, not recycled market noise. So in this video, we're going to walk through the market split, why AI hardware is still attracting money, why some software and consumer names look tired, and why one uranium company deserves serious attention. Not blind worship. Attention. There is a difference, and it matters. Because here's the strange thing. The broad market can look fine while half the market is wheezing in the corner. You see the indexes up, you see a few mega themes ripping, and you think everything must be healthy. Then you lift the hood and you realize the market is not rising evenly. It is sorting companies into winners, survivors, and businesses that may have a very unpleasant meeting with reality. The winners right now are close to the AI buildout. Not just AI apps, I mean the physical build-out. Chips, memory, networking, power semiconductors, cooling, electricity, transformers, construction, and eventually fuel. AI is not a little box on your phone. AI is industrial infrastructure with a friendly user interface. And that's why the hardware names have looked so strong. The big cloud and platform companies are not spending because it feels cute. They're spending because none of them wants to be the company that underbuilt compute capacity during the biggest platform shift since the internet. Once one giant signs contracts, orders chips, books power, and starts building, the others cannot just sit there and say, actually, we're going to be disciplined. Discipline sounds wonderful until your competitor has the model, the customers, the data, and the compute. So the AI capex cycle is still the center of gravity. But that does not mean every AI stock is a bargain. Some of these valuations already assume the future arrives on time, under budget, with no mistakes, and wearing a little bow tie. That is usually not how the real world works. Now, software is more complicated. Some software companies will become more powerful because AI makes their products better, stickier, and cheaper to deliver. Others may discover that their moat was really a confusing dashboard, a long contract, and an overworked sales team. So when investors sell software broadly, I understand the fear. But I also think it's too lazy. The market is probably throwing some future winners into the same trash bin as the company's AI will quietly eat. Consumer-facing businesses have a different problem. Regular people are stretched. Prices went up, insurance went up, rent went up, and wages did not magically outrun everything. So if a company needs the average household to keep absorbing price increases forever, I would be careful. That's not doom. That's just the receipt. Now let's talk about the part that most people are still underestimating: power. Recently published energy work shows data center electricity demand rising sharply through the end of this decade, with AI-focused power use expected to grow even faster than ordinary data center demand. That is not a small footnote. That is the missing engine in the AI story. If you build intelligence at scale, you need electricity at scale. And this is where nuclear comes back into the conversation. Not because nuclear is fashionable. Nuclear has never been fashionable. It's too slow, too technical, too political, too easy to misunderstand. But it has one thing the AI economy desperately wants: steady, always-on power. Solar helps, wind helps, gas helps, batteries help. But a massive AI campus does not want power that only works when the weather feels generous. It wants reliable baseload electricity. That is why large technology buyers have been signing long-term nuclear power agreements, supporting restarts, and looking at advanced reactor deals. This is not some random green branding exercise. It is a power procurement strategy. Now here's the problem. If America wants more nuclear power, it needs a stronger domestic nuclear fuel chain. And that brings us to uranium. The United States has the largest nuclear generation fleet in the world, yet domestic uranium production has been tiny compared with what the country consumes. Public government numbers show that the overwhelming majority of uranium bought by owners and operators of American civilian reactors has come from foreign suppliers. That is not automatically a crisis tomorrow morning, but it is a strategic weakness. And when Washington starts using words like energy dominance, national security, and fuel cycle, you should probably listen, even if the words make you want to take a nap. The policy direction is clear. The government wants American nuclear capacity to be much larger over time. The stated goal is roughly to move from around 100 gigawatts to several hundred gigawatts by mid-century. Now, will that happen perfectly? Probably not. Nothing involving permits, utilities, regulators, construction, and politics happens perfectly. But even partial movement in that direction changes the demand conversation. And this is why Uranium Energy gets interesting. This is not just a company saying, one day maybe, if the moon behaves, we might produce something. The company has moved into production at Burke Hollow in Texas, and it also has activity at Christensen Ranch in Wyoming. Based on recent company updates, it now has 2 active American in-situ recovery platforms producing at the same time. That matters because markets often treat a producer differently than a permanent storyteller. The balance sheet also matters. According to the latest publicly available filings and company updates, Uranium Energy reported a large liquid asset position, including cash and uranium inventory, and no debt at quarter end. Again, I'm rounding the details because I don't want you memorizing decimals like a court stenographer. The point is that many commodity companies get destroyed because they need money at the worst possible time. Debt gets heavy, dilution gets ugly, projects slip, shareholders get turned into confetti. A clean balance sheet does not remove risk, but it gives management breathing room, and the uranium sales economics have recently looked strong. The company reported sales above the average spot price for that quarter, while early production costs at its operating base were far lower than the sales price. Again, this is not a guarantee of future margins. Commodity prices move, costs move, ramp-ups are messy, but the spread is exactly why the market is paying attention. Now, the part that could really change the story is not just mining, it is conversion. Uranium does not jump from the ground straight into a reactor and start politely producing electricity. It has to go through a fuel chain. One of the important steps is conversion, where uranium concentrate is processed into a form used before enrichment. America has limited domestic conversion capacity, and that is a bottleneck. Uranium Energy is pursuing a domestic refining and conversion initiative, and the license process has been moving through the public regulatory channel. If that project eventually lands, the story shifts from miner to more integrated fuel chain player. Notice the word if. That's the word that saves money. If it gets licensed, if it gets built, if costs stay reasonable, if policy stays supportive, if uranium demand keeps strengthening, investors get into trouble when they delete all those ifs and replace them with definitely. That's not analysis. That's a bedtime story with a ticker symbol. So the way I would frame Uranium Energy is simple. There is production. There is a supportive policy backdrop. There is AI-driven electricity demand pushing attention toward nuclear. There is domestic supply chain pressure. There is a strong balance sheet, and there is a potential conversion catalyst that could matter a lot. That combination is rare enough that I want it on the watch list, even if I still respect the risks. Now, some people will say, why not just stay with the obvious AI winners? Fair question. You can. But the obvious AI winners have already been discovered by everyone, their cousin, and probably their cousin's dog. Uranium is a second-order AI trade. It is not the model. It is not the chip. It is the power behind the building that houses the chip that trains the model. Less glamorous, potentially very important. And that brings us to the other infrastructure names people keep asking about. Navitas is a good example of how the market is starting to care about power architecture inside AI data centers. The company has talked about gallium nitride and silicon carbide devices built for high-voltage AI factory systems. Translation, as AI racks get denser, power delivery gets harder, hotter, and more valuable. The stock can move violently because small names with big themes do that. They go up fast, then they breathe, then people panic, then the story gets retested. Welcome to small cap investing. Please keep your helmet on. AMD is another case. For a while, the market treated it like the permanently second best option in AI accelerators. But second place in a massive supply-constrained market can still be worth a fortune. Recent strategic deals with major AI buyers show that customers want alternatives, capacity, and leverage against a single dominant supplier. AMD's position is not simply, can it beat the leader tomorrow? The better question is whether the market is large enough for AMD to take meaningful share while also benefiting from server CPUs, AI GPUs, networking, and rack-scale systems. And with agentic AI, the infrastructure mix gets broader. When AI stops being just a chatbot and starts doing tasks, planning workflows, writing code, searching files, operating tools, and responding in real time, the workload changes. Inference grows. Latency matters. CPU demand matters. Networking matters. Power matters. The AI trade becomes less about one magic chip and more about a whole industrial stack. Now, let me challenge one popular idea. Not every dip deserves to be bought. I know, radical stuff. Some dips are gifts, some dips are warnings. If a stock falls because the market panicked while the business improved, that can be opportunity. If a stock falls because the story was fake, the balance sheet is weak, or dilution is coming like a freight train, that is not a dip, that is gravity doing its job. Which takes us to VisionWave. VisionWave is a very speculative defense technology company working around AI sensing, counter-drone systems, RF imaging, autonomy, and related acquisitions. The theme is real. Modern warfare has changed. Cheap drones create expensive problems. Sensor overload creates decision delays. Electronic warfare makes it harder to trust what a system sees. Defense buyers increasingly need fast detection, classification, and response tools across air, land, sea, and space-linked systems. But this is the part where we breathe. A great theme does not automatically make a great stock. VisionWave is small. The filings show financing activity, share registration activity, acquisitions, and development stage technology. That means opportunity, yes, but also dilution risk, integration risk, execution risk, commercialization risk, and the classic small cap problem where the story sounds bigger than the income statement. So if you research it, do the uncomfortable work. Read the filings, look at the share count, look at cash needs, look at what is closed and what is still pending, look at what is deployed commercially and what is still proof of concept. Don't buy adjectives. Adjectives don't pay you dividends. If you're successful, share your success story in the comments so others can stay motivated. But also share the boring lesson that helped you avoid mistakes, because that is usually more valuable than the screenshot of the win. So here's where I land. The market is not just bullish or bearish, it is selective. It is rewarding infrastructure and punishing fragile stories. AI hardware matters, power matters, uranium matters, nuclear policy matters, defense sensing matters, but execution matters more than all of them. For uranium energy, the bull case is that America needs more domestic uranium. Nuclear power is getting policy support. AI is increasing electricity pressure. The company has active production, a large liquid asset base, no debt, and a possible fuel chain catalyst through conversion. The bear case is also real. Uranium prices can fall, production can disappoint, permits can slow down, nuclear projects can take forever, and markets can ignore a good story longer than your patience lasts. So don't treat this like a lottery ticket. Treat it like a thesis. Write down what would make you buy, what would make you sell, and what would prove you wrong. Most people skip that step, then call their emotions research. And one more thing, don't confuse national importance with shareholder returns. A sector can matter enormously and still punish investors if the company pays too much for assets, issues too many shares, misses timelines, or sells into a weak price cycle. That's why the watch list is not the same as the buy button. The watch list is where ideas earn the right to get studied. The buy button comes only after the numbers, the catalysts, and the downside all make sense together for you. Not before that. Ever. Question for you. Is the better AI trade from here the obvious chip leaders or the hidden infrastructure behind them? And on uranium, would you rather own the producer, the commodity, or avoid the cycle completely? Drop your answer in the comments. My view is this. The next stage of the market is going to separate people chasing headlines from people following bottlenecks. Compute is a bottleneck. Power is a bottleneck. Domestic fuel supply is a bottleneck. Defense sensing is a bottleneck. When capital finds bottlenecks, prices can move faster than people expect. Just remember, this is educational commentary, not personal financial advice. I don't know your portfolio, your taxes, your time horizon, or whether you panic sell when a stock drops before lunch. Use this as a starting point for your own research, check the filings yourself, and make decisions that fit your own risk.